Welcome to vTalkInsight, Market Drivers Daily for February 3rd, 2026. Today, markets are wrestling with three big forces at once. An AI investment boom running into tougher questions on payback, historic turbulence in precious metals spilling across assets, and geopolitical swings that are knocking oil lower even as tail risks stay elevated. Let's start with how the AI story is evolving. The AI narrative is moving from pure enthusiasm into a tougher phase where every dollar of spending is being questioned. Over the past week, we have talked about a powerful global Capex cycle in chips, memory, and data centers. Now, the same infrastructure build-out is colliding with investor concerns about leverage, dilution, and the timing of returns. That shift in tone matters because AI has been a core pillar of equity leadership and a major underpinning for risk appetite. Oracle sits at the center of this debate, with plans to raise on the order of $50 billion to expand cloud infrastructure for AI workloads. The funding mix spans a large, multi-part bond deal and equity-linked issuance, with roughly half of the package coming from new debt and early outlines suggesting a similarly large equity component. Investors are weighing the upside from long-term contracts with clients like OpenAI and major chip makers against near-term pressure from higher leverage, potential equity dilution, and the fact that private equity or sovereign wealth backstops have not been prominently featured. Credit markets have reacted, with Oracle's spreads and credit default swaps moving noticeably around the announcement, underscoring how AI Capex is now a credit story as much as an equity one. Oracle is not alone. A major cloud provider and other large tech firms are also looking to tap as much as $50 billion each to fund data center expansion, even as investor appetite for massive AI Capex shows signs of fatigue. NVIDIA's chief executive has stepped back from earlier talk of a $100 billion OpenAI investment, clarifying that it was not a firm commitment. That nuance alone has been enough to pressure NVIDIA shares and feed a broader tech sector pullback. At the same time, AI-linked metals, such as copper and tin, have come under pressure as traders reassess how fast infrastructure will actually be built, and speculative positioning in Shanghai copper futures has started to unwind after record volumes during last week's sell-off. Put together, these signals point to a market that is no longer blindly funding every AI project, but instead demanding clearer visibility on cash flows and returns. Despite the wobble, AI-related equities are not moving as a single block. Hardware, memory, and data center names that can show strong earnings and Capex delivery still enjoy support, while software and platform companies without visible AI monetization are under heavier pressure. Recent commentary suggests that future gains in leading AI stocks may increasingly depend on significant earnings beats, shifting leadership toward firms that can prove tangible cost savings or new revenue from AI deployment. Names like Palantir, which is guiding to well over triple-digit commercial growth, and SanDisk, which has surged more than 180% year-to-date on AI-related demand, highlight how differentiated execution can still attract capital even as the broader theme cools. Beyond the near-term shakeout, the structural AI story remains powerful but more nuanced. AI investment is boosting aggregate GDP and is expected to lift productivity, yet many current products still deliver unreliable outputs and have not translated into broad-based margin expansion, which is fueling valuation concerns and talk of localized bubbles. Large, cash-rich hyperscalers are shouldering much of the borrowing, reducing systemic leverage risk compared with past tech booms. But questions linger about whether future productivity gains will be enough to justify today's debt and equity issuance. At the same time, the ecosystem is expanding. There is talk of space-based AI data centers, a merger between SpaceX and xAI with a combined valuation above $1 trillion, and a rotation into downstream beneficiaries and industries, such as financials, healthcare, and manufacturing. For markets, the key watch points now are upcoming earnings from major AI platforms like Alphabet, the reception to large bond deals funding cloud infrastructure, and hard evidence of AI-driven revenue and margin improvements. all of which will shape whether AI remains a leadership engine or becomes a source of tech-led drawdowns. The current volatility spike is radiating out from precious metals, where price action has been extreme even by historical standards. Gold has just seen its steepest two-day decline since around 1980, with prices falling by roughly $1,000 in that window and erasing a large portion of recent gains. Silver has been even more disorderly, plunging about 30 to 40% over 3 days in some measures, with single-session drops near 16% and intraday swings that briefly pushed year-to-date performance in a negative territory. What began as a move driven by central bank demand has morphed into a market dominated by hedge funds, momentum traders, and highly levered retail flows, including from China, leaving both gold and silver far more vulnerable to rapid liquidations. This metal shock is not happening in isolation. Sharp declines in gold and other metals have triggered a broad sell-off in mining and metals shares across Asia, with rising concern that volatility could spill into European and global commodity-linked equities. Oil has joined the downdraft, with crude benchmarks such as WTI and Brent dropping around 5%, as easing geopolitical risk premiums and the broader commodity unwind reinforce each other. Major equity indices like the S&P 500 and Nasdaq are extending multi-day declines, while safe haven flows are visible in a stronger dollar and lower treasury yields, even as implied volatility remains more elevated in commodities and currencies than in core equity and bond markets. Under the surface, positioning looks stretched and increasingly fragile. Record 2 to 3 standard deviation moves in metals, rapid reversals in silver that wiped out weeks of gains, and sensitivity of silver to even modest exchange-traded fund flows all point to a market where leverage and thin liquidity are amplifying every headline. Speculative retail investors who helped drive up Bitcoin, gold, and silver are now facing renewed volatility as parabolic rallies give way to profit-taking and forced selling, with knock-on effects across foreign exchange and other commodities. Overlaying this, investors face potential Fed balance sheet reduction, diverging G10 rate paths, and a partial U.S. government shutdown that may delay key data releases, creating an environment where technical factors and policy uncertainty interact to magnify price swings. There are, however, counterforces preventing this from turning into outright panic. Some wealth managers report that clients are largely sticking to long-term plans, using diversification and gradual rebalancing rather than wholesale de-risking in response to the turbulence. Many analysts also argue that the recent pullback in gold and silver is primarily a correction from unsustainable, momentum-driven rallies rather than a signal of deteriorating macro fundamentals. Gold's strategic case remains tied to persistent inflation risks, elevated government debt, and geopolitical uncertainty, and its expected trading band over the next year is unusually wide, with scenarios ranging from the high 3,000s to the mid-5,000s, underscoring both its diversification role and its volatility. Looking ahead, the key risk markers sit at the intersection of metals, leverage, and broader risk assets. One scenario being discussed is that a further drop of around 10% in gold from here could trigger meaningful fund-level stress, especially if weakness bleeds into crowded trades in tech and AI-related equities. At the same time, volatility has so far been more contained in core equity and bond volatility measures than in commodities and foreign exchange, suggesting either resilience or a potential lag before cross-asset contagion emerges. Market participants are watching for signs of forced deleveraging, liquidity squeezes as any Fed balance sheet changes come into view, and technical equity levels that, if broken, could accelerate risk-off behavior, all of which link directly into the geopolitical drivers that are now reshaping energy and safe haven pricing. Geopolitics are adding another layer of complexity, particularly in energy and safe havens. Oil prices have moved sharply lower as markets lean toward a de-escalation narrative between the United States and Iran, even though military assets remain mobilized and rhetoric from Tehran still includes warnings of regional war if U.S. strikes occur. Benchmark crude contracts, such as WTI and Brent, are down roughly 5%, and major oil companies like BP and Shell have seen their shares soften as risk premiums are marked down. This repricing reflects more headlines about back-channel diplomacy than any change in physical supply, which leaves the door open for sudden reversals if talks falter or an incident in key shipping lanes occurs. On the ground, regional powers are heavily engaged in damage control. Countries including Saudi Arabia, the United Arab Emirates, Qatar, Turkey, and Egypt are mediating to keep Washington and Tehran at the table, motivated by a strong desire to avoid conflict spillover and disruption to trade routes. Analysts draw a clear distinction between a large-scale U.S. attack on Iran, which could trigger a sustained spike in oil prices and shipping costs, and more limited strikes that might produce a brief price jump followed by mean reversion. Compared with past decades, the global oil system now looks more flexible, with preparations to keep the Strait of Hormuz open, incremental barrels from places like Venezuela, and U.S. shale consolidation, including the Qatar and Devon Energy merger, helping to cushion sustained supply shocks, even if short-term volatility stays high. Beyond the Middle East, the war in Ukraine continues to exert a more grinding but significant influence on energy and risk sentiment. Ukraine's power infrastructure is sustaining near-daily attacks, with estimates that more than half of generation capacity is damaged or offline, and repeated strikes on the same facilities leaving equipment in fragile condition. Temporary lulls in attacks, reportedly linked to diplomatic intervention, have created only brief repair windows, and the grid remains highly vulnerable to further outages, especially during harsh winter weather. This persistent pressure reinforces concerns about European energy security, while also feeding into demand for safe havens such as gold, which has increasingly acted as a barometer of geopolitical risk rather than a simple reflection of jewelry or coin demand. These geopolitical dynamics intersect with both gold and currencies. Despite its recent plunge, gold's medium-term backdrop is still described as supportive, anchored by expectations of eventual Fed rate cuts under new leadership, sticky inflation, and unusually high geopolitical uncertainty. Unlike in past episodes, gold has tended to retain much of its gains after risk events, leaving the price base higher and more sensitive to fresh shocks, while forecasts now span a very wide range, reflecting genuine disagreement about its future path. At the same time, some global investors are increasingly hedging U.S. dollar exposure when they express views on U.S. equities or AI themes, citing policy and political risks and a desire to diversify reserve assets. Trade and energy flows are also in flux, with a U.S.-India deal that includes India stepping back from Russian oil purchases, potentially reshaping who buys which barrels and at what terms. Pulling this together, geopolitical risk is currently exerting a paradoxical influence. Spot oil prices have fallen on hopes of diplomacy, but the distribution of possible outcomes has widened, keeping tail risks in focus. Investors are parsing every signal on the scope of U.S.-Iran negotiations, which span nuclear issues, missile programs, and regional proxy conflicts, knowing that missteps could quickly reprice energy, shipping, and defense-related assets. They are also tracking the intensity of attacks on Ukraine's grid, signs of domestic instability in Iran, and the implementation of new trade arrangements that could alter global energy and currency dynamics. The overarching implication is that while markets are currently leaning toward de-escalation, portfolios remain exposed to sudden spikes in oil and renewed demand for gold and dollars if diplomacy falters, a backdrop that keeps risk management, rather than directional bets, at the forefront of geopolitical positioning. To sum up, AI remains a central growth engine, but massive, debt-funded Capex plans from names like Oracle and its peers are facing sharper investor scrutiny, making future earnings delivery and balance sheet discipline critical to sustaining leadership. Historic volatility in gold and silver is exposing leverage and stretched positioning, with metals now a key barometer for broader risk appetite and potential contagion into equities, credit, and foreign exchange. Meanwhile, oil prices are signaling near-term optimism on diplomacy, with Iran even as the risk of sudden geopolitical shocks, from the Middle East to Ukraine, keeps energy and safe haven markets on edge. Across these themes, markets are rewarding evidence over narratives, and the next moves in Capex guidance, metals positioning, and diplomatic headlines are likely to drive the cross-asset tone. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.